Welcome everybody to our update on Brompton Sustainable Real Assets Dividend ETF. I'm Chris Cullen, head of ETFs at Brompton. Very pleased to be joined today by Laura Lau, our CIO, and we will be talking about real assets today and in the context of just the latest investor concerns about inflation and recession. And I hope you come away today with some very good examples of how real assets can work really well for clients in situations such as we find ourselves today. Just before we begin, I'm going to start with some disclaimers. I urge you to read these disclaimers through thoroughly, but I'll just summarize right now. Please, before you invest, read the prospectus. ETFs charge fees and expenses. You should be aware of that. Past performance may not be repeated. We may make forward-looking statements today, which are not guaranteed to actually come to pass. But please take a moment and read through these disclaimers at a later time. Real assets is a timely investment theme. What we have right now on this graph is just a comparison between several real assets ETFs, including our offering, which is BREA on the Toronto Stock Exchange, the Brompton Sustainable Real Assets Dividend ETF. Which is in blue at the top. And all of these ETFs are lined up since the inception date of BREA. So BREA, along with, to be fair, the competitors in this space have done very well, just given the turbulence that we all witnessed in 2022 in the equity markets. So BREA has provided investors with steady growth and solid income throughout this time. And we think that the time for investing in real assets themes is not done yet. So our product offering, Brompton Sustainable Real Assets Dividend ETF, it's an actively managed product, actively managed by Laura and her team. So that's in terms of both the global equities in the portfolio, which are actively selected, and the portfolio is constructed by our PM team, but also our team executes a proprietary active covered call overlay in which Laura and team attempt to monetize some of the volatility in the portfolio and turn it into current call premiums, which enhance distributions. We are a market leader in actively managed covered call strategies, and we have a significant experience in global equities through our PM team. Real assets are a very stable source of income and a stable source of growth, as I think the chart on the last page illustrated. They've outperformed the global equity market in general and tend to offer higher dividends and higher cash flows than your typical equity. They are defensive, but they do have growth theme exposure, and so you get the best of both worlds. The yield on this product, BREA, is 5.2% per annum. That's a monthly distribution. The portfolio is a global portfolio, but the currency exposure is hedged back to Canadian dollar. And we charge a very reasonable fee for such an active strategy, 75 basis points per annum. So as far as the team that oversees the investments in this portfolio, as I mentioned, Laura Lau, who will be speaking in just a moment, is the head of the investment group at Brompton Funds. She has significant experience over 25 years as a portfolio manager, and she is eminently qualified, as well as being an industrial engineer. She holds a CFA designation, and she's also a derivative market specialist. So the right person to execute this global equity portfolio with a cover call overlay. She's supported mainly by Maggie Meng, but also the rest of the investment team at Brompton Funds. Maggie specializes in sectors that overlap very strongly with the real asset themes, including utilities, telecom, real estate, and some certain industrials, which are all part of the real assets theme. So strong support by Mike, Varun, Billy, and Utsav, my mistake, in the investment group for Laura and Maggie. And just with that introduction, it's time to pass the floor over to Laura to give us the overview on real assets. So over to you, Laura.
Thank you, Chris. So how does Brompton define real assets? So we have some pictures here. So they're really assets that are tangible, you can touch and feel. So we have some pictures here. So things like utilities, power plants, electric grids, infrastructure, railways, airports, toll highways, real estate. So we got a residential building here, office warehouses, communication services, and also commodities. So things like oil, gold, copper, lithium. So why should you be interested in real assets? So we talked about some of the real assets that are available. You can see utilities, real estate, infrastructure, and we combine them into real assets. You can see that the return, which is on the left-hand side, and the volatility on the other axis, you can see that when you combine them into a real assets portfolio, you can actually get higher returns with lower volatility, which is, especially after these last few years, clients really want lower volatility. So what are some of the characteristics of real assets? What's so special about them? Why do you want them to be part of a portfolio? Well, they tend to have very long, useful lives, usually in terms of decades. They're typically built to provide essential services, and we've seen how important that is during COVID. So things like supplying water, electricity, transportation, like railways and airports, garbage collection services, housing, and they're very difficult to be replaced. So typically there's initial high upfront costs to build this infrastructure, and then that makes very high barriers to entry and generally less competition. With less competition, they have strong pricing power and tend to have higher profit margins. They also tend to pay very stable income, so it's very suitable for investors who are looking for lower risk, dividend paying securities to own. And I think in this kind of environment, in a high inflation environment, they provide very good hedge on inflation. So as I said, real assets include commodities, which has been a big source of inflation. And they often have escalators built into the contracts that they sign with customers. So usually it's inflation plus. And also it includes utilities, and there's a built-in formula for return they're allowed to earn based upon inflation and also based upon higher interest rates, which we're also seeing now. So that's why real assets do perform very well during inflation. So we have two charts here on the left. You can see the returns when inflation's high, over 2.5%, for global real assets in the blue, global equities, and global investment grade bonds. You can see in a higher inflation environment, such as we're experiencing now, real assets do perform very well. So now let's talk about what we expect for 2023. It's always hard to predict the future, but what we do expect is a recession this year. You can argue this has been the most anticipated recession. And with the recession, we do expect the Fed to stop hiking and inflation to start falling. We do expect inflation to be higher for longer. And part of the reason why is we're seeing increasing geopolitical risk. The US is no longer the only superpower in town. We do have a multipolar world, which is leading to trade wars and higher inflation. We're seeing the demographics change with a lot of these baby boomers retiring, so there's just not as much labor. So we do expect inflation to be higher than the 2% that the Fed, is targeting longer term. And we also see China reopening, and this pushes out that recession. So this is how we think Brompton believes the real asset sectors should perform in this kind of environment. So let's start with utilities. Utilities do tend to perform well in recessions. It's really the risk off trade, the funds flows to defensives. In terms of real estate had it was a very difficult year last year with the market anticipating a slowdown with also higher interest rates. So I'll show a chart later that shows that when the Fed stops hiking, real estate does tend to perform better. And with infrastructure, think things like toll highways, think airports, they do perform better when the population starts moving again, remobilizing. And they should also perform well when the long-term interest rates start peaking with the expectation of recession. And we're already starting to see that, where the long-term interest rates are starting to roll over. So telecommunications also tends to be very defensive and outperforms during recession. Nobody really wants to cancel their cell phone or their internet during this time. So whereas we do expect funds flows to go into telecommunications. In terms of energy, this is probably a little more controversial, but pipelines tend to be more defensive during recessions, and we do believe oil will outperform gas. The oil market is poised to tighten with the China reopening. Materials, base metals also are outperforming with the China reopening. We are in Chinese New Year now, and when Chinese New Year is over, the Chinese go back to work and start ordering more metals and start building again. Gold has been rallying on a weaker US dollar, and gold will ebb and flow like it always does. So what this chart shows is how utilities perform during recession. So the blue bars are the recessions, and you can see the line is how they perform versus the S&P 500. So you can see that during recessions, utilities do tend to outperform. So REITs, so they tend to outperform after the rate hike stops. So this shows how REITs perform relative to the S&P 500 during the last Fed rate hikes. So that's about 11 times since 1998. So the dark blue is how do the REITs outperform over 90 days, and the light blue is after 180 days. And the last bar shows the median of the last 11 hikes, and the second from the last shows the average. And you can see that in general, REITs do outperform once rates do stabilize. So when you think about it, the world's overinvested in technology, digital. I still think that we need to make that investment, but as a result, we've really underinvested in the real economy. So this shows this for oil and gas and coal, which is the dark blue line on the top. This is the capital expenditures, and the bottom one is for mining, and you can see that we've really not spent, and as a result, we're really struggling to keep our production even flat. And the big thing is, if you look at the pipeline of new discoveries, they're not really there, whether it be at oil and gas or the mining side. So we don't really have enough copper in this world or lithium for everyone to have electric vehicle. So we do need to invest more, I think, in commodities. So these are some of the secular growth themes we see for real assets. We do expect, with definitely high deficits with COVID, that the government has to outsource more of their infrastructure needs. And we're seeing increased government support for infrastructure and other clean initiatives and the growth of ESG. And we're also seeing the greater need to connect our world because of the growth in e-commerce, 5G, and IoT. And we still see the growth, continued urbanization of the population. So this chart is from McKinsey for the global infrastructure spending needs for 2017 to 2035. So you can see the total infrastructure spending need is estimated to be about 3.7 trillion every year. So by the year 2035, the gap between what we spend and what we actually need will be about 5.7 trillion. And we've seen with COVID spending, the government balance sheets are very stretched. So just to give you a stat, since the beginning of COVID, the US overspent, above trend, US $8 trillion. And it's really tough to raise more tax revenue. So we believe that governments will have to turn to the private sector to help with this infrastructure spending, whether it be building roads, water infrastructure. But when you think about it, things like power plants, telecom, and railways are usually the domains of private companies. And that's why we do see increased spending on infrastructure going forward. And we're also seeing that the government is all over the world are giving increased spending, whether it be tax credits or just other support for green spending. So the latest one was the US Inflation Reduction Act, things like renewable energy credits for solar and wind, credits for electric vehicles. And we don't have on here that even before that, Biden had a $1.2 trillion infrastructure spending plan that he passed. And that will include spending for things like transportation, electric grids, renewable energy, and building up water infrastructure and internet. And the European Union kicked it off with a Euro $1 trillion Green Deal for the next decade, and the Power EU plan to reduce Europe's reliance on Russian gas. So this is just a trend we see going forward, and we've seen this translate into the growth of renewable energy. So this chart shows the global projected renewable energy capacity. And you can see that's just exploded since 2012. Biden has set a target for the US to be carbon neutral by 2050, and China has set the target to be carbon neutral by 2060. So for power generation, you can see the greatest growth in our alternative energy will be particularly solar, which is in the green bars, and wind, which is in the blue. And due to better technology and scale, the cost of renewable energy have been dropping. The cost of renewable energy on a full life basis is actually cheaper now than burning fossil fuel. So we don't actually need subsidies, stands on its own economics, and that's why we've seen this explosion in growth. So another driver we've seen has been important since the pandemic is hyperconnectivity, how technology has been connecting everything, especially with work from home. People are realizing the importance of the internet and staying connected. So we have the rise of the Internet of Things, 5G, and e-commerce that all translate into greater data requirements. So the need for hyperconnectivity can be seen by the growth in the interconnection bandwidth, which is in this chart. Interconnection bandwidth measures the capacity to transfer traffic via direct and private interconnections like data centers. So we've seen companies like Google, Microsoft all use their data centers to provide many of those cloud software and services that they offer. So things in terms of data usage, number of data centers and cell towers will all increase with the 5G rollout, and we see greater density of cell towers with 5G and greater need for data centers. So real asset companies would include companies that have data centers, communication service companies, tower, who will all be major players in hyperconnectivity. So the last theme would be urbanization. So the number of people in the world are projected to grow to over 9 billion by 2070. So currently about half the global population lives in cities. We expect this to grow to 58%, or another 1.5 billion people by 2070. And all these people are going to need housing and infrastructure. So even with COVID, people are still moving to cities, but they tend to be moving to the tier 2 and 3 cities that are cheaper. So we still see this trend continuing even with COVID. So just one slide to talk about an investment process. So we use a top-down analysis. So especially now we're in a very macro-driven market. So we do things like analyze the economy, the business cycle, sector, and that helps drive our sector allocation and also our geographical allocation. So for instance, at this point in time, we do think that with the growth of renewable energy, that is a very good sector to be, so we're overweight that. And then what we do is for the individual companies, we screen on quant and technical, and then we do the fundamental bottom-up analysis, especially for real assets companies. It's very important to look at things like free cash flow, dividends, and this particular time, debt, especially with the cost of debt rising, how much of this debt is termed out, the cost of debt, and any needs for debt or equity raises. So we have ESG integration on all levels. So as I talked about how we look at ESG in terms of sector allocations, and also ESG in terms of geographical allocations, where are we getting government support, and the individual company level. So we do use a covered call overlay to enhance the yield on the overall portfolio and lower the volatility. So we do manage over 2.5 billion in covered call strategies around the world. So in terms of sector and geographical allocation, that's on the left. So in Canada, there are many good renewable energy companies. In Europe, there are many good infrastructure companies, like, as I said, companies, airports, toll roads. We're currently underweight real estate, but we do expect to increase this allocation as the Fed stops hiking. So these are some of the companies in the portfolio. So it is a global portfolio. We do have companies in Europe, Japan, Hong Kong. So I'm just going to highlight two of the companies in the portfolio. So you've probably never heard of the construction company in Spain called Ferrovial, but you probably have heard of the Highway 407 toll road in Toronto, which I would argue is one of the best infrastructure assets in the world. And if you haven't heard of the 407, you probably have flown to or flown through Heathrow Airport, which is one of the busiest airports in the world. And on the engineering side, this is one of the most sustainable construction and engineering companies, and it benefits from the European government green stimulus. So this company is in the portfolio. And another company you probably have heard about would be Kinder Morgan. So they operate pipelines in the United States. So pipelines are still the safest, most economical, and lowest carbon emissions way to move any hydrocarbons. So Kinder Morgan operates the largest natural gas network in the United States. So in terms of revenue, it's very safe. So 61% is take or pay, which means whether the hydrocarbons move through or not, they're still entitled to payment. It's really a reservation fee for capacity. So they get paid no matter what. 26% is fee-based, which means they collect a fee. Doesn't matter what the commodity price is. It's really based on volumes and not commodities. So it's really not exposed very much to commodity prices. But it is a leader in energy transition. They have the largest network of CO2 pipelines in the United States. Right now, most of it's used for enhanced oil recovery, but with the Inflation Reduction Act, they put in a lot of tax rebates to make carbon capture projects much more viable. And as I said, they have the network, they have the expertise, so we do expect growth in projects there. Right now, they're seeing a big growth in renewable natural gas, and a lot of that gas comes from landfills. So it's got a very healthy 6% yield, and in terms of valuation, it's actually a lower valuation than the S&P 500. So I'll just hand this back over to Chris to close off the presentation.
Thank you, Laura. That's a great overview and fantastic examples, I think, at the end of real assets issuers and what they do. So just a quick one, why would you want to partner with Brompton? Well, I mean, we're offering ETFs with unique themes and unique geographic focuses. We offer active management and very attractive distributions from all of our ETFs due to both a focus on high dividend equities and also on covered call writing by our PM team. So all of that in a bundle that's offered at a low cost. I think that there's a very attractive value proposition for your clients. We provide services to 20 TSX listed investment funds and ETFs. In addition to our ETF suite, we also offer 7 split share corporations, which many of you may be familiar with in the IROC channel. We have over 20 years of experience in this space. And this is just an example of how focused we are on distributions. We have actually paid out over $3 billion in fund distributions since we started up operations in 2000. So that's about the same order of magnitude as our current AUM. So lots of distributions, and that remains a very strong focus for Brompton. And we know that many clients have that focus as well. I mentioned our equity mandates, the active cover call programs also bring down volatility as well as producing additional distributable cash to enhance distributions. We have 2 fixed income ETFs currently, and we have one closed-end fund that focuses on fixed income, and those are both specialty asset classes which offer kind of higher than average distributions. And we for our fixed income, we go outside of Brompton. We employ sub-advisors who we vet best in class. So I think quite a good package is offered for Brompton ETFs. And there we go. This is our sales team. If you are an advisor, please reach out to your sales contact if you'd like more information on BREA, or if you'd like to ask some follow-up questions for Laura. If you're an individual investor, please call our investor line. That's at 1-866-642-6001. Well, this concludes the presentation for today. I'd like to thank everybody for joining, and yeah, I hope to be speaking to you on this topic very soon.